Investments in securities are subject to market risks. Read all related documents carefully before investing. Hello and welcome to the Weekend Investing Daily Bytes. Today we are shooting this episode on 7th of June and the market continues its rally up. We are now within striking distance of a new all-time high. The previous highest closing was 18,800 odd. We are now at 18,726. On a weekly basis, we are probably already, if we close here this week, we're probably already at a new all-time high. So amazing run since March end. It's not even been a full quarter, but we've come all the way from 16,900 to 18,700. And on the back of disbelief, largely, uh, a lot of fence a lot of not believing this rally so far. And because the narrative is such, the narrative is around recession in the US, the narrative is around interest rates still not topping out, the narrative is around not enough credit growth happening, so on and so forth. So essentially this is what I've observed over the last 27 28 years in the market. It is that we are always trapped in the narrative, and the negative narrative usually has a lot of more weight than the positive narrative around you. And believe me, there is not much of positive narrative around you anyways, because somehow the media, somehow what we read on social media, what we see on the television is geared more towards negatives, geared more towards giving a fear backed feedback loop, and that keeps your positive instincts a bit subdued. Whereas when you're doing momentum investing, when you're doing something in a more structured fashion, a non-discretionary fashion, then you don't really care about all these narratives, because there are 50,000 different moving parts and you cannot really make sense out of all of them, and the market will always surprise you. So if you think you can beat the market in terms of you not being surprised by the market, then of course you should do discretionary because you are an expert at that then. But most people, I can tell you, 99% people are always surprised by the market, and that is the reason why you need to go non-discretionary and in a systematic manner. Anyhow, so coming back to Nifty doing extremely well. You can see largely green screen on the Nifty heat map. Very good gains in the FMCG sector, as Nestle up almost 3%, Britannia up 3.5%, Tata Consumers, Hindustan Levers all up. Good gains in uh, Coal India, BPCL, Energy Group. Good gains in Tata Motors, Aisha Motors, some gains in Maruti. Then you had some minor gains in banking sector, State Bank, Axis Bank, some in life insurance, HDFC Life, SBI Life, and some muted sort of moves in IT also. So power seems to be recovering, the energy sector, and autos and FMCG are doing quite well. Uh, the other sectors like real estate, metals are not. Real estate and which one I was talking, consumption stocks are not so much represented in the Nifty, but you can see that the real estate stocks are leading the pack at plus 1.6% again. Metal stocks have, I think, metals are now starting a good rally after creating some base formation. Metals have been consistent now for the last, I would say, few months. They're not, at least falling or being in the second half of the gainers. They have been consistently near the top. So over 3 months, you can see almost 6-7% of gains, which is pretty much the top half of the gains. My focus would be on real estate, metals, public sector enterprise doing very well. So we were going to talk about public sector enterprise stocks today, post this market update. Commodity stocks doing well, FMCG I already mentioned, infrastructure, energy stocks doing well, consumption stocks gaining. IT stocks gaining 0.8%. Pretty much all sectors gaining across the board. But the point to note here is that the banking sector has been the weakest today. So private banks up only 0.1%. PSU banks, yes, up 0.7%. Overall, Bank Nifty is up 0.3%. So usually, Bank Nifty is the sector which is leading the market, but that is not happening right now. Maybe what is happening is that Bank Nifty is allowing the rest of the market to catch up, come near the all-time high before it sprints off again. That is a possibility for us to see. But in case Bank Nifty does not go up and does not break out and so sort of tends to go down, then I think very soon you will find that that essentially that weakness or that the lack of strength will rub off on the rest of the market also. I think without Bank Nifty really cannot do too much, is my belief. Let's see how that works out. But real estate, of course, has been done tremendously well with 23% gains over the last 3 months. Mid caps, as we've been mentioning, have been going up like a rocket. Just see the move here from 29,000 to 34,000, just going up, just like we had in this June 22 move. And then we had a sort of a quiet period for the next 6 months, and then it has taken off again. It's almost like a flag pattern here, and also breaking out from the top. Small caps, again, amazing run from 8,500 to 10,200. Nobody was expecting this. And this has now potential to again go test this previous high at near 10,500. I think very good moves here. Yes, it is a bit overbought. We may get some shake off at some point, but that is part of the market. So I think the shake off now, when it comes, it will probably come back and maximum may come down to this level and retest the breakout and then go up again. That is my belief. That may happen. Bank Nifty, you can see here, has been stuck in this sort of confusion range, although it is still very near a all-time high. So nothing as bad as I may be sounding, but again, it's not leading the rally forward. Now let's talk about public sector firms, public sector enterprise stocks. So this is the public sector enterprise index, the Nifty PSE. What we see here is that we had a huge boom in public sector stocks from 2002 to 2003 levels. So that last huge rally that we had from 2003 to 2008 gave a huge boost to public sector enterprise. So we went from 400 to nearly about 2,800. So 7x was the move before 2008 happened. And just see what happened after 2008, which is of importance here, that after the 2008 crisis and correction, it again moved up. 2008 is here. So 2008, we went 400 to 4,400. So almost 11x that we did. But after 2008, essentially, it came into a very sideways kind of a mode, which has lasted almost 15 years. So 2008 and now it is 2023. We are just about breaking out now after that humongous consolidation of 15 years. Why is that consolidation taken that much time? Because we moved 11x within a span of 6 years. Just imagine 11x on the index. Just imagine where the stocks would have gone. So whenever there will be a dramatic large move, there will be a dramatic long period to digest those gains. And that is what has happened. This is exactly like real estate, where you had a great move from 2002-3 till 2012, and only now in the last couple of years has it started to pick up again, because the kind of move that happened in those decades, it essentially has brought forward and discounted the entire gains of the next decade within that short time span. So you're kind of squeezing the gains of the future into the present and enjoying that right now. So that is why all this valuation game is very difficult, because you don't know what is the market discounting today. I mean, there are stocks in the US which are trading at 30-50 times sales also, large companies. So you don't know whether from tomorrow till the next decade they will not go up, possibly. because they have to digest all these gains for so long. Anyhow, so PSE, public sector enterprise stocks, new high, going up, looks very, very strong. Post COVID, also amazing run from this bottomed at 1200 and now we are at 4800 something. So post COVID also great return. And if we see the comparison with other indices, so let's do a comparison. Let's say 20 years. So now this is the public sector enterprise index. Over 20 years, it is up 200%. Nifty is up 900%. Uh, Nifty IT is up 1100%. Nifty Auto is up 1400%. And Nifty FMCG is up 1700%. Just see over 20 years what is the underperformance of public sector enterprise. It is amazing underperformance. And quite amazingly, FMCG has topped out of these five sectors at least. Now let's cut to 10 years. Last 10 years from 2013 onwards, we see that public sector enterprise still the laggard within these five, but not so bad actually. So done 87% versus autos at 180, Nifty at 200, FMCG also at 200, and Nifty IT at 228%. So 20 years was bad, 10 years was not so bad. And now let's look at, since COVID. So since March 2020, so about 3 years, we find that public sector enterprise is up 96%, right here in the middle. Better than Nifty at 81%, better than FMCG at 71%, better than CNX IT at 95%, only behind CNX Auto at 120%. So what we are seeing is that sectors that have not performed for a long period of time, reverting to the mean sort of, and also the fact that the governance of the current government is causing a lot of public sector balance sheets to be cleaned up, a lot of restructuring to be happening, efficiencies to be brought back. I think that all is helping all these companies really revive. Like for instance, today there was a news that Hindustan Aeronautics and GE have tied up for the jet engines. A huge deal that is happening. And so when there are many stocks that have really, really done well. PFC, I mean, a stock that had been stuck in a range since the last 15 years is breaking out strong. It has almost doubled in the last 7 to 9 months. Hindustan Aeronautics, as I was just talking about, it's gone bonkers. It was near 500 rupees at the bottom of COVID. It is now 3,500 rupees, 7x on HAL. REC Limited, which had been stuck in this range since 2009-10, again breaking off. I don't know if it will actually go up in as a flag breakout, but still promising, I would think. Public sector banks also doing quite well after a very long period of time. You can see that they did well from 2003 till 2011, and then they never took off after that. In fact, 2017 to 2020 was really bad for them, and now they are coming back up and almost near new highs. Canara Bank also amazing run, almost 325% since COVID. Again coming back post COVID strongly. BHEL, a really battered stock, which was down to 20 rupees from it used to be 1,000 rupees at some point of time, recovering, gradually moving up, recovering and getting new orders and restructuring. So extremely good data points on public sector enterprise stocks. I think one can be very watchful of several of these stocks. We are seeing this in the railway stocks also. Several of them have been the market leaders. Defense stocks, several of them, whether it is Mazagon docks, or whether it is port stocks. Then you have even stocks like Engineers India, stocks like HMT. These are all running because there is scope of restructuring, there is scope of inefficiencies coming around. So public sector enterprise index itself looks very, very promising to me. One can try to look for winners here, try to look for trade setups. If you are a discretionary trader, look for trade setups on every dip. These are currently, some of the stocks are on a buy mode, and you can have your risk set up and go for these stocks. We, in our portfolios, we have several of these public sector enterprise stocks, whether they are public sector banks, whether they are defense stocks, whether they are railway stocks. Several of these have come into our portfolios because we are, open to any stock entering our strategies, regardless of what narrative that may be stuck to them. So sometimes, we don't buy stocks because there is some narrative which is negative, and we believe that narrative will continue. But when you see that stocks are willing to go up, and the stocks are giving you that indication that I want to be a multi-bagger, then you should allow them into your portfolio and see the magic there. So this is all I have for today. Thank you so much for watching this, and I'll see you in the next one. Bye.